if you look at the last few decades of financial innovation and inclusion that has taken place, in many cases, the financial world has solved really well for high value, low volume transactions. And we have all kinds of networks that have been created to support that. You have networks that support different types of cross border transactions. You have open finance ecosystems that are coming up in different countries across the world. Many of us in India have experienced UPI when it comes to fast payment systems. But what we realized was that as each of this infrastructure was being built, both in India and across the world, in a very purpose specific manner, what was happening is when we wanted to extend this infrastructure to other types of assets, to other jurisdictions, it was becoming really difficult. For example, most cross-border connections take, on average, 5 years when two fast payment systems connect with each other. Now imagine 190 countries into 190 countries. That's a few centuries beyond much of our lifetimes. Or even domestically within a country, when one looks at expanding the infrastructure to different kinds of financial assets, it takes a really long amount of time. And so, as we started to look at this, saying the needs of society are increasing to digitally transact, to use different types of assets across different types of transactions between other individuals, between businesses, and other institutions, the current approach of building infrastructure doesn't lend itself quite well. And we really needed to rethink and go back to first principles around how we were building this, because a lot of people as a result were being held back from economically participating within the system. And the reason what's happening is, to give you a very simple analogy, every time we create a new car within the financial system, we build new roads, right? So you'll have a separate payment and settlement rails for person to person transactions. And then in some cases, you'll have separate rails for person to merchant. In some cases, you'll have separate payment rails for higher value payment transactions, and then separate rails for cross border. And then altogether separate rails for security settlements and so on and so forth. And so, logically, as you can extrapolate that, if you want to interconnect these systems, it has high transaction costs. And so, a lot of this thinking, this purpose specific thinking, results in the silos, results in the slow speeds, results in the expensive nature of a lot of the transactions within the financial system. But what we started to realize as we looked at this was that technology fundamentally starts off purpose specific, right? So if you go back early days of the internet, what did you see? You saw very purpose specific networks created. You'd have enterprise companies giving you a custom stack across software, protocols, hardware, custom email stacks, for example. And those would offer you guarantees of privacy and security, etc., on this entire custom stack. But moment the needs for society to transact with each other increased, you started to bridge onto the public internet. You started to see public protocols being created, and then applications starting to control the flow on top of those public protocols, which is what all of us use today, which is how I'm able to dial into this as well. And what that did is it allowed for specialization at each level of the supply chain to come in, interoperability to come in, a large part of humanity to be onboarded onto the internet, which is not possible to do on any of these custom end-to-end stacks before. We saw the same even with smartphones, right? Pre-smartphones, you had purpose-specific technologies like a camera. People, all of us would use different cameras, different microphones, different feature phones, etc. But the power of converging them, the power of unifying them, the power of creating a programmable abstraction on top, which is essentially what smartphones did in some ways, really unlocked a whole new innovation ecosystem on top. And as we've been building infrastructure over the last decade, decade and a half, and in more purpose specific ways, we feel we are in a critical juncture within the financial system where essentially things are starting to converge. And we can start to imagine a much more universal, much more unified, much more user-centric paradigm towards how we think about doing and enabling these different types of transactions. And really, that thinking is what drove the Finternet. So it may seem a bit of an abstract concept because we sort of uh, uh, dug into a lot of the basics of these while coming up with how do we even think about this problem. But the journey started off about a year and a half, now almost 2 years back, along with Augustin Carstens, a general manager from the Bank for International Settlements, previously the central bank governor and finance minister of Mexico, and his team at the BIS, along with us in India. So this was driven by Nandan Nilekani, Pramod Verma, and myself. And we started to really think through this common vision, which finally culminated in the Finternet paper, which we released in Washington, D.C. in April of this year, along with central bank governors from Brazil, Germany, and Korea. And there are two papers that are there. One's a companion paper as well, and you can find this on finternetlab.io. But what is the essence of this? The essence was really one, can we imagine a world where individuals, all of us, are given complete agency and control over any asset? And so these could be assets ranging from money to securities to carbon to digital content. How do you make those assets transactable? And how do you give that control to make it transactable back to individuals and back to businesses? So the Finternet also looks at how do you include different types of businesses slash legal persons, which could be organizations of different types within the formal financial system. The other aspect to this idea of making it user centric, which was important to us, was the legal notions behind this. So, one is from a technology perspective, but from a legal perspective, just as a bit of a thought experiment, imagine so I'm dialing in from the US. Imagine we had to share health data from a hospital in India with a doctor in the US for a second opinion. Let's say there was a specialized second opinion that had to be done. Now, what are the two ways you could imagine that health data was shared? One, you have the hospital in the US and the hospital in India attempting to integrate with each other along with support from their governments. And so you're trying to harmonize HIPAA norms from the US along with DPDP, which is the privacy legislation in India. Quite unlikely it's going to happen in any of our lifetimes. The alternate is if the hospital in India gives back verifiable machine readable data to the individual, and then the individual, using consent, has the mechanism to share that data with a doctor in the US, right? And so when it's routed via the individual, you have the ability to imagine a paradigm that satisfies compliances in both jurisdictions without ever having to sort of harmonize and integrate at a system to system level. And that's very key because when we look at the financial system, go back to the paper world of how we did transactions for a minute. So imagine physical cash or physical equity shares, any physical financial instrument. Let's say I gave you, sitting here in the US, I gave you one of the audience members in India a US dollar bill, right? Now, once I've handed that over to you, you have the ability to instantly verify it, validate it. You don't have to talk to any other third party system. It's a self contained, self describing token. You can see the value, you can see all the attributes present within that. And also, it's instantly settled. Once I hand it over to you, it's yours. However, when we digitized over the last few decades within the banking, capital markets, and broader financial system, when we digitized, the asset sat somewhere else, the validation and verification sat somewhere else, and now my systems slash my bank systems had to integrate with your bank systems, and that's where the complications came in because in most cases these systems wouldn't talk to each other. In the few cases they did, it was very purpose specific, high transaction cost systems that got created because Anytime you have a system to system integration, you have to think about liability and all of these complex questions. And our view is, given the more recent cryptographic developments that are taking place on digital signatures, public chains, etc., it allows us to imagine a digital world sort of back to the future of just like you had physical tokens, but now with the programmability and all the other elements that digital brings in. So that's one key idea behind the Finternet. The second key idea is across diverse asset classes, regulated asset, registered assets, assets that have third party attestations, and user control assets. How do you unify and create a unified experience for the user? Not uniform, it doesn't have to be one singular, but architecturally, how do you allow for the coexistence of these diverse asset classes? They continue to operate with their own governance norms, but the user doesn't have to run around to, different systems and portals as they do today. They can initiate those transactions in a much more unified manner. To think of it again, back in India, a version of this unification is what we've achieved in a limited manner, let's say within the banking system. So when you use UPI, it unifies across different stores of value, whether that's a bank account, whether that's a wallet, whether that's a credit card, but then it doesn't cut across other asset classes. If you look at the account aggregator system, which allows access to data, that cuts across banking, capital markets, insurance, pension funds. But then if you want to bring in property, it doesn't unify across that. So if we can imagine a much more expansive unification of any asset an individual or business could potentially have, how can we create a unified experience is sort of the second core idea that the Finternet has been looking at. And the third is, if we need to build this infrastructure, we need to build it on a lot more universal rails. So rather than replicating everything from scratch, sector after sector, jurisdiction after jurisdiction, are there universal rails that can plug in, but you can continue to program and regulate the flow depending on the type of asset that is being looked at. And so that's really a very distilled version of what the Finternet is. And a large part of it relies on the core idea of tokens and tokenization. So as I mentioned to you, it's really back to the future. It's a lot of the similar concepts you had in the physical world in terms of portability, self-contained, self-describing packets, but then you now enhance this with the digital advancements that allow you to make it programmable, interoperable, the ability to fractionalize, cut it up in parts, which you can't do with paper, so on and so forth. And so, really, tokens are the electronic representations of these assets, of any claims on these assets. And this is key. So, for us, tokens doesn't necessarily represent ownership. Ownership is a specific characteristic. It could represent any type of claim. For example, on top of a physical property asset, you go on to create a rental agreement that you then want locked and want to get financing against it. That is again a specific type of claim that could also be tokenized. So that's really one aspect when you sort of double click what the Finternet is looking at, and it leverages cryptographic advances across public chains, and there are developments that we've been working with crypto ecosystems across the board on, around how do you bring in privacy by default to the chains? How do we think about the ability to control the flow? How do you leverage the immutability that these chains bring in? The work that's happening on wallets and digital signatures, which allows portability of credentials. So think of this as more advanced versions, again, from an India context of DigiLocker, which houses about 8 billion verifiable credentials today. 300 million people use it. And that's just sort of early days, but shows you the power of giving individuals back their identity in different shapes and forms and allowing them to transact with that. And so, really, the Finternet takes an expansive view of different types. Our view is you can unify across these different types, although they might seem to be large, independent, siloed sectors of their own, but different types of assets. And so, you have regulated assets on one end. This could be different forms of money, central bank money, commercial bank money, other forms of private money, depending on jurisdictions like stable coins, etc., or listed securities. It could be registered assets. These are assets that typically are backed by a registrar. So, for example, physical property, a vehicle, every time you buy, that's registered in the registrar. So those can be tokenized as well. Attested assets, essentially anyone that has third-party ratings, credentials, attestations attached to it. Imagine energy resources, carbon, gold is another example, or user-controlled assets. This is like digital content, art, music. And really what you're doing by unlocking transactability of these assets, you're now giving choice for people to participate in the upside of the broader economy, or also through insurance. And you know, once you have the ability to tokenize these assets, you can make them financeable, and that means lendable, insurable, investable, and so they can also protect themselves from various sorts of downsides that may take place. So, given this context, what does the Finternet sort of look like? Here's a quick high-level overview. Central to this is, of course, the idea of both individuals and businesses being at the core behind all of these transactions. Second is the idea that they would interface with the Finternet across a broad range of applications of their choice, and these applications fundamentally can be developed by any developer across the world. These are the front-end experiences behind all of the workflows. On the left-hand side are where you have both new companies as well as existing institutions plug in, and we call them token managers. So fundamentally, imagine a bank. So you could tokenize a deposit from a bank. It could be a central bank. It could be a private company. You start up today. Often, when you raise funds as a startup, the process of raising equity capital is high transaction cost. You have the ability to tokenize those shares as a company as well. So you have various types of token managers. You, as an individual, could be a token manager for your own assets as well. But fundamentally, token managers are, in some shape or form, helping manage the flow of these assets across the Finternet ecosystem. And so let's look at a token manager like a bank. You now tokenize your deposit account, issue it onto a ledger of the individual's choice. And that's very key. The individual is not going to the bank's ledger or a private company's ledger or an asset manager's ledger to transact. These assets are being issued into the individual's ledger. And that really inverts the entire equation, while the token managers may continue to be a part of the flow for consumer protection reasons, fraud, so on and so forth. And so now what you see out here is the individual having different types of assets being made available to them, issued onto their ledger across real estate, equity, carbon credits, so on and so forth. And you can have third party value-added service providers. These essentially get attached to a transaction to lend additional trust. These could be escrow agents, guarantors, notaries, so on and so forth. And all of this happening, in our view, within an environment that leverages existing legal frameworks and regulations. But in some cases, there may be amendments made in terms of legal admissibility of a token. How is this verifiable evidence produced and accepted in a court of law as part of dispute resolution, et cetera, et cetera. And so we do expect, in some cases, jurisdictions to come up with additional enhancements. But in many cases, just because you tokenize, it doesn't change the underlying legal nature of these asset classes. And therefore, you can leverage a lot of the existing governance frameworks that are there. Now, what I thought I'd show you is a bit of a quick use case beyond a traditional use case of money and some of those, but a use case from the world of sustainability financing where it brings out some of the composability elements behind the Finternet. Now, today, carbon markets largely, a lot of us know, are broken. They're really broken because of the lack of trust, and that trust comes down to verification costs, high transaction costs, etc. And so there's a high cost in establishing provenance. There's a lack of interoperability across the different transactions that take place. And then as a result, it results in repetitive verifications needing to be done. And so these markets end up being low volume, high cost, trust being highly fragmented. if these ecosystems had to now participate within the Finternet, what would that look like, right? So you've got users can use any application and open an account on any ledger of their choice. The ledgers fundamentally are interoperable with each other. So this individual goes on to procure a solar roof. As part of that procurement and installation and setup, a set of proofs are issued into the account of the user. Think of it into the user's wallet. This could be proof of installation, proof of the equipment. They're nothing but a set of digitally signed credentials issued back into the user's wallet. Over and above that, the user wants to get an additional audit done from a third party energy auditor. Request for that verification. This can be through a different set of applications. Once that verification is done, those additional proofs and credentials get issued back into the user's wallet. Again, this has nothing to do at this point with the financial system. But then when you go to the next step, the user can leverage this set of proofs that they have to now unlock different types of financing on top of that. Right. And so you could unlock different types of tax credits, carbon credits, green financing, a specific debt financing that's been made available. And the financial system or financial institutions don't have to bilaterally integrate with the solar roof provider or the energy auditor to do some sort of validation and things like that, because those bilaterals end up restricting the market that is available. But because of the structure that I just shared with you, the user can share their credentials, they can be underwritten, the funds can be dispersed, whether that takes the form of money or debt and so on and so forth, into the user's account. So this is really an example of one of the possibilities on the Finternet, but the community is really imagining different types of flows, different types of use cases. There are quite a few papers on this if you go to finternetlab.io as well, beyond just the example I mentioned. Now, I do want to also bring out a few other characteristics that are important when we think about the broader world of tokenization and all of these asset transactions is dispute resolution, because things will go wrong. It's a good assumption to make that whatever can go wrong will go wrong. And so, in that scenario, how do you think about mediation? How do we think about arbitration, conciliation across different multiple parties? Therefore, the primitives that are part of the Finternet in terms of verifiability lends itself to allowing you to share that provenance of those transactions, provenance of those assets. It allows you to access online dispute resolution providers much easier. And the digital evidence trails also allow for much better supervision, auditability, and observability. And as a result, in many cases, as some of us may be familiar, some of these asset disputes last decades in court. Most of the time in those decades is just spent even aggregating that evidence together, establishing authenticity of the evidence. Only the last leg is actually, an application of one's mind in terms of what needs to be done. So you can actually shave off quite a few decades when it comes to these types of issues that may come up across different assets. So fundamentally, what we're doing here is creating a playground where regulators can regulate, innovators can innovate, and really thinking about how do you layer on top of highly universal technical standards, protocols, infrastructure, the right kinds of governance norms that then open this up to all of humanity, 8 billion people, 300 million businesses. And so, from that lens, we also believe that in addition to private sector, public authorities do play a key role within this ecosystem. And this is important because when you think about and we see this even within the evolution in the crypto ecosystem, right? So when things go wrong, you have to go back to the court system to settle it. You can't settle that completely using smart contracts. You'll just unnecessarily increase the complexity, computational complexity of these systems. And so when we looked at it very pragmatically, it became quite clear because you do need public authorities that lend and take care of some of these additional sort of guardrails that become critical to unlocking transactability. And that will vary jurisdiction to jurisdiction, sector to sector, as they roll out different parts of the Finternet. Very quickly, what this also does is it within jurisdictions strengthens the regulatory and supervisory capacity because in many cases today they have a hard time implementing reg tech and sup tech apps because there's no infrastructure available. And so even entrepreneurs that build these technologies end up having to silo it. Now think of it just like a app store. RegTech and SupTech entrepreneurs can deploy their supervisory technology, fraud technology, etc., onto a common playground that can then be leveraged by public authorities within this. So there's a large international community that's starting to come together since we published the paper in April. I'll urge you to take a look at the work that's happening. A lot of them are present at India Blockchain Week as well. And we'd love to have more of you be a part of this and help us really think through different aspects behind the Finternet. We don't have all the answers, so we're really just taking our time learning as much as what's been built across different ecosystems. We are in the process of setting up a network of labs across the US, Singapore, Switzerland, UK, Middle East, and of course one in India. And that will really work on both the underlying technical rails, but also on adoption pilots that are there. And so while the broader vision is quite ambitious, you don't really want to, within the financial system, move fast and break things because that loses a lot of trust quite quickly. And so we are really thinking through what are the right set of use cases? How do you calibrate this rollout? How do you calibrate this action? And really asking questions like what works at scale, right? So if you had to imagine a world where you're doing 100 billion transactions a day, UPI already is doing 500 million transactions a day. We expect UPI to get to a billion transactions a day. If the FinTech becomes a reality, every jurisdiction has its own fast payment system plus more, easily 100 billion a day. What works at scale, right? So scaling what works is very different from what works at scale. And so you really want to calibrate that rollout, identify the right intersection between where the technology is mature, but also the ecosystem is ready, ecosystem is mature. But this will play out. I think it's quite clear over the next 10, 20 years. This is the future of the financial system, but each jurisdiction will calibrate their adoption journey at each step of the way. And how do you create unifying infrastructure? So whenever they're ready, they can plug in. But when they do, they're part of an interoperable whole, not siloed segments. So that's really an overview of the Finternet. Thank you so much for taking the time, and I hope you guys have a lovely rest of your conference at the India Blockchain Week. Thank you.